In 2025, the way you handle your crypto taxes is going to change for good. The IRS is rolling out a brand new crypto tax form that will completely transform the landscape for every single investor in the United States. This isn't just some minor update, it's a total overhaul. And if you hold any crypto, Bitcoin, Ethereum, NFTs, even stablecoins, and you're not ready for this, you're at serious risk of not just making mistakes, but of massively overpaying on your taxes. For years, the IRS has had to rely on self reporting for crypto, and they know that system is leaky. Well, that era of maybe they won't notice is officially over, starting with your 2025 transactions, which you'll file in early 2026. The game completely changes. The IRS is done guessing what you're doing. They're about to get a boatload of data straight from the exchanges themselves. This isn't a scare tactic, it's a fact. But here's the catch: they don't advertise. The information the IRS is about to get on you could be dangerously incomplete. This could lead their automated systems to assume you owe way more in taxes than you actually do. Ignoring this is simply not an option. But understanding how these new rules work is your best defense and your most powerful offense. In this video, I'm going to break down exactly what's changing, expose the single biggest trap that could cost you thousands, and give you a precise step-by-step playbook on how to use the tax code to your advantage before it's too late. This is the new reality of crypto, and getting ready for it starts right now. All right, let's get right into it. The catalyst for this whole tax shakeup is a new form called Form 1099-DA. The DA stands for digital assets. Think of it like the crypto version of the Form 1099-B you get from your stockbroker. For years, when you sold stocks, your broker sent both you and the IRS a 1099-B breaking down your trades. It tells them your sales proceeds, your cost basis, and your gains or losses. It made it incredibly easy for the IRS to track your stock market activity. Crypto, though, has been living in a gray area. Exchanges might have sent you a 1099K or 1099M ISC, but those forms were messy and didn't give the IRS the details it really wanted. This led to a huge tax gap, the difference between what the IRS thinks it's owed from crypto gains and what it actually gets. The 1099-DA is the government's billion-dollar answer to closing that gap. So, what is it exactly? Starting with the 2025 tax year, any company defined as a broker has to issue a Form 1099-DA to you and, more importantly, to the IRS for all your digital asset sales and exchanges. Let's break that down. Who's a broker? This is where things get interesting. The definition from the Infrastructure Investment and Jobs Act is incredibly broad. It basically includes anyone who helps you transfer digital assets. This obviously means major exchanges like Coinbase, Kraken, and Binance.us. If you sell crypto on those platforms, you can bet you'll be getting a 1099-DA from them. But the definition was so wide, it initially caused a panic, with many worrying it could include non-custodial players like wallet developers or even miners and validators who have no way to comply. While the Treasury has since clarified that it doesn't intend to target miners, stakers, and wallet providers for now, the primary targets are crystal clear: the centralized platforms where most people buy and sell. These are the on-ramps and off-ramps the IRS is focused on monitoring. What's on the form? This is the crucial part. For the first year, covering your 2025 transactions, the Form 1099-DA will mainly report one key piece of information: gross proceeds. That's the total dollar value you got from a sale. If you sell one Bitcoin for $100,000, the form will tell the IRS you received $100,000. It's a simple, powerful number. And this brings us to the most dangerous part of this new rule: a ticking time bomb for any investor who isn't prepared. For the 2025 tax year, brokers are not required to report your cost basis. Let me say that again. The first wave of these forms going to the IRS will show how much you sold your crypto for, but not what you paid for it. This creates what I call the cost basis nightmare, and it's what we're covering in the next section. The bottom line is this: the days of what the IRS doesn't know won't hurt me are over. They will now know about your sales, and their computers will be looking to match that report with what you put on your tax return. If there's a problem, or if you don't report at all, you're flagging yourself for an audit. The question isn't if the IRS will know, but what you're going to do about it. This is the most important section of this entire video. If you only remember one thing, make it this: the single biggest danger of the new Form 1099-DA is the potential for missing or just plain wrong cost basis information. Not understanding this could literally cause you to overpay your taxes by an astronomical amount. First, a quick refresher on cost basis. Simply put, your cost basis is what you paid for an asset, including fees. If you buy a share of stock for $100 plus a $5 fee, your cost basis is $105. Sell it for $200, and your taxable gain isn't the full $200. It's the sale price minus your cost basis. So, $200 minus $105 leaves a $95 gain. That $95 is what you pay tax on. It's investing 101. Here's the problem. In the stock world, you usually buy and sell in one brokerage account. Your broker knows exactly when you bought, what you paid, and when you sold. They have all the data, so the 1099B they send is usually complete, showing both your proceeds and your cost basis. Crypto is a completely different universe. You might buy Bitcoin on Coinbase, move it to a hardware wallet, then transfer it to Kraken to trade for an altcoin, then move that altcoin to a DeFi protocol. The path is complex and scattered across different platforms. Now imagine this scenario under the new 2025 rules. Let's say years ago you bought one Ethereum for $500 on an exchange that doesn't even exist anymore. You moved it to your ledger and let it sit. In 2025, you decide to cash out. You transfer that one ETH, now worth $10,000, to your Coinbase account and sell it. What happens next? In early 2026, Coinbase sends a Form 1099-DA to the IRS. It will show you had gross proceeds of $10,000. But what will it show for your cost basis? Since the ETH was transferred in, Coinbase has no idea what you originally paid. All they see is an asset appearing in your account and then being sold. Their records will likely show a cost basis of $0. So, the form that lands on the IRS's desk says $10,000 in proceeds and $0 cost basis. The IRS's automated system will see that and assume you have a $10,000 taxable gain. Your real gain, though, was $9,500. $10,000 sale, $500 cost. By default, the IRS will think you owe tax on an extra $9,500 of income you never even earned. Now multiply that across dozens or hundreds of trades. The potential for an insane tax bill is enormous. This isn't a maybe. This is the default outcome if you do nothing. The burden of proof is on you to correct the record. When you file your taxes, you'll use Form 8949 to report the transaction correctly. You'll list the $10,000 of proceeds Coinbase reported, but you will enter the correct cost basis of $500 to calculate the correct gain of $9,500. But to do that, you need one thing: proof. You need records of that original $500 purchase. If you don't have them, you're in a tough spot. You're basically telling the IRS, trust me, the form is wrong, with no evidence. In an audit, that's a losing fight. The IRS will go with the broker's data, and you'll be stuck paying tax on a $10,000 gain. While brokers will eventually have to report cost basis, this system won't be perfect for a long, long time. It won't solve the problem for assets you transfer in from other wallets or exchanges. Relying on them to get it right for you is a recipe for disaster. This leads us straight to your new game plan. If the problem is a mismatch between what your exchange reports and what you really owe, the solution is to build an unshakable, bulletproof record of your entire transaction history. The days of casual crypto investing are over. The era of the diligent crypto bookkeeper has begun. These new rules basically create a personal requirement for meticulous records. It's not a best practice anymore, it's a financial survival skill. On top of that, another big change is the move to wallet-by-wallet accounting. Before, you could often pool all your assets to figure out gains. Starting in 2025, you have to track the cost basis for assets on a wallet-specific or account-specific basis. That means the cost basis for your Bitcoin on Coinbase has to be tracked separately from the Bitcoin in your hardware wallet. This just adds another layer of complexity and proves how critical detailed records are. So, what do you actually need to do? You need a complete history of every single crypto event you've ever been a part of. This includes every purchase, date, time, fiat amount spent, crypto amount received, and fees. This sets your cost basis. Every sale, date, time, crypto amount sold, and fiat amount received. Every crypto to crypto trade. So many people miss this. Swapping one crypto for another is a taxable event. You're selling the first crypto and buying the second. You need to record the fair market value in dollars of the crypto you sold at the moment of the trade. That becomes the cost basis for the new crypto you got. Every time you spent crypto, using crypto to buy coffee is a taxable event. You're selling your crypto for the value of the item you received. Record it like any other sale. Every time you received crypto as income. This is for things like getting paid for work, staking rewards, airdrops, or mining. The dollar value when you got it is ordinary income, and that value also becomes your cost basis for those coins. Every transfer between your wallets. While not taxable, tracking these moves is essential for proving the chain of custody for your cost basis. You have to be able to prove that the ETH you sold on Coinbase today is the same ETH you bought somewhere else 3 years ago. Doing this by hand in a spreadsheet is possible, but if you have more than a few transactions, it's an absolute nightmare and prone to errors. This is where crypto tax software becomes your best friend. Services like CoinLedger, Coinly, and CoinTracking are built for this. You connect your exchange accounts and wallet addresses, and the software automatically pulls your history, matches up transfers, and calculates your gains and losses. Using one of these services isn't a luxury anymore. It's the most effective way to build that bulletproof defense you need. When it's tax time, these platforms can generate the completed Form 8949 for you, showing the correct cost basis for every sale. In an audit, having these reports is your ultimate shield. It shows the IRS you're not just guessing, you have a system. Your new mantra has to be, if it's not recorded, it didn't happen. Now that you understand the problem, the new 1099-DA, and the defense, keeping perfect records, it's time for the fun part. Going on offense. The US tax code might be complex, but it's also packed with rules that can legally and dramatically reduce your crypto tax bill. Now that you're forced to get organized anyway, you're in the perfect position to use these strategies. Let's break down the most powerful ones. Strategy 1, master tax loss harvesting, the crypto superpower. Tax loss harvesting is a fantastic tool for any investor, but it's especially powerful in crypto. The idea is simple. You sell assets that are down in value to realize a loss on paper. You then use those capital losses to cancel out your capital gains. For example, let's say in 2025, you sell some Bitcoin and have a $10,000 capital gain. You'd normally owe tax on that full $10,000, but you also own some Solana that's currently down $8,000 from what you paid. You can sell that Solana and harvest the $8,000 loss. That loss directly offsets your Bitcoin gain. Your net capital gain drops from $10,000 to just $2,000. You just legally wiped out 80% of your taxable gain. If your losses are bigger than your gains, you can use up to $3,000 of the extra loss to lower your ordinary income, like your salary, which is a huge win since that's taxed at higher rates. Any leftover losses can be carried forward to future years. Now, here's what makes this a crypto superpower. In the stock market, there's something called the wash sale rule. It stops you from claiming a loss if you buy back the same stock 30 days before or after the sale. It's to prevent people from selling for a quick tax break and jumping right back in. As of right now, the IRS sees crypto as property, not a security, so the wash sale rule doesn't apply. This is a massive advantage. It means you can sell your Solana at a loss, and if you still believe in it long term, you can buy it back minutes later. You get to book the tax loss without giving up your position. Huge disclaimer here, this is a loophole. Lawmakers know it exists and they want to close it. While you can use it for your 2025 taxes, don't assume it will be around forever. The draft version of Form 1099-D even has a box for wash sale losses, which tells you the IRS is getting ready for when the law changes. But for now, it's one of the best strategies you have. Strategy 2, the art of holding. Long-term capital gains. This is the most basic tax strategy there is, and it's more important than ever. The tax code is built to reward long-term investors. It does this with two different tax rates for capital gains. Short-term gains. Hold an asset for 1 year or less, and your profit is taxed at your ordinary income tax rates, which can be as high as 37%. Long-term gains. Hold an asset for more than 1 year, 366 days or more, and your profit gets taxed at much lower rates, 0%, 15%, or 20%, depending on your income. Just look at how powerful this is. For 2025, if you're a single filer and your total taxable income is below about $48,350, you pay 0% on your long-term gains. If your income is between that and about $533,400, you pay 15%. Think about someone in the 32% federal tax bracket. A $10,000 short-term gain costs them $3,200 in federal tax. If they had just held on for a few more days to make it a long term gain, their tax would only be $1,500, 15%. That's a $1,700 savings just for being patient. Your records are what will prove your holding period, so a simple habit of checking the purchase date before you sell can save you thousands. Strategy 3: choose your weapon. Cost basis methods: FIFO, HIFO, Spec ID. This is a bit more advanced, but it's a huge deal if you've ever bought the same crypto at different prices. When you sell, you need to decide which specific coins you're selling. The IRS lets you choose your accounting method, and your choice can make a big difference. First in, first out. This assumes the first coins you bought are the first ones you sell. In a rising market, this usually means higher gains because you're selling your oldest, cheapest coins. HIFO, highest in, first out. This is often the best for minimizing taxes. It assumes you sell the coins you bought at the highest price first. This results in the smallest possible gain or the largest possible loss. Specific identification, Spec ID. This gives you total control but requires perfect records. You handpick the exact lot of crypto you want to sell to get a specific tax result, like realizing a specific loss to offset a gain. For example, say you own 2 ETH. You bought 1 ETH at $2,000 over a year ago. You bought 1 ETH at $4,000 recently. The price is now $5,000 and you sell 1 ETH. Using FIFO, you'd sell the first one. Your gain is $3,000, $5,000 minus $2,000, and it's long term. Using HIFO, you'd sell the second one. Your gain is only $1,000, $5,000 minus $4,000, and it's short term. Which is better? It depends. If you want to minimize your tax bill now, HIFO is the winner. If you want to lock in a lower long-term gain rate, FIFO might be the move. With good records, you and your tax pro can choose the best method for your goals. Strategy 4: the generosity play, donating and gifting. Crypto. You can also use strategic giving to lower your tax bill. Charitable donations. This is a seriously overlooked strategy. If you donate appreciated crypto you've held for more than a year to a qualified charity, you get a double tax benefit. First, you completely avoid capital gains tax. Second, you can usually deduct the full market value of the crypto from your income. It's a massive win-win. Gifting crypto. You can also gift crypto to friends or family. For 2025, you can give up to $19,000 to any person tax-free without even filing a gift tax return. When you gift crypto, the other person inherits your cost basis and holding period. This can be a smart way to pass wealth to family members in a lower tax bracket. Strategy 5: the Uno reverse card tax gain harvesting. This sounds weird, but it's brilliant if you're having a low income year. Tax gain harvesting is when you intentionally sell an appreciated asset to realize a gain, then buy it right back. Why would you do that? To use the 0% long-term capital gains rate. Remember, for 2025, if your income is low enough, under about $48,350 for single filers, your long-term gains rate is 0. Imagine you're a student with little income. You have Ethereum you bought 2 years ago for $1,000 that's now worth $10,000. You can sell it, realize a $9,000 gain, and pay $0 in tax. Then you immediately buy it back for $10,000. You've just reset your cost basis to $10,000. In the future, when you're in a high tax bracket and sell it for $50,000, your taxable gain will only be $40,000, not $49,000. You used a low income year to lock in $9,000 of gains completely tax free. Strategy 6: the ultimate tax shelter, the crypto Roth IRA. For the true long-term believer, the Roth IRA is the holy grail. You contribute after-tax money, and your investments inside grow completely tax-free. All qualified withdrawals in retirement are also 100% tax-free. You can't just move your existing crypto into one, but you can open a self-directed IRA that allows crypto investing. You contribute cash, then buy crypto inside the account. For 2025, the contribution limit is $7,000 or $8,000 if you're 50 or older. Imagine buying Bitcoin in a Roth IRA and holding it for 20 years. You can trade inside the account as much as you want with zero tax consequences. When you retire and that portfolio has ballooned, you can withdraw it all without paying a dime in capital gains. For a young investor, there is no more powerful tax strategy. Okay, we've covered the problem, the defense, and the offense. Let's boil it down into a clear checklist. These are the things you need to do now to get ready. Step 1, get your records in order now. This is non-negotiable. Sign up for a crypto tax software service. Connect all your exchanges and wallets, going as far back as you can. Your goal is to have a clean, complete history before January 1st, 2025. Step 2, Review your portfolio before year end 2025. In late 2025, sit down and look at your holdings with taxes in mind. Find your losers. Those are your candidates for tax loss harvesting. Find your winners and check their holding periods. Can you wait to sell until they go long term? Step 3. Decide on a cost basis method. With clean records, you can see how HIFO or SPECID would change your tax bill. Talk this over with a tax pro to pick the best strategy for you. Step 4, evaluate advanced strategies. Are you in a low income year? Are you feeling charitable? Is it time to finally open that crypto Roth IRA? Figure this out now so you can make your moves during 2025. Step 5, find a qualified crypto tax professional. This is not the year to wing it. You need a CPA or tax pro who actually understands digital assets, from DEFI to the new 1099DA rules. Get in touch with one early, not in April 2026. The new 2025 crypto tax rules are a monumental shift. Form 1099-DA is the end of the crypto tax Wild West. The IRS is building a surveillance system for digital assets, and every investor is on their radar. But this doesn't have to be a bad thing. This new reality forces all of us to become better, more disciplined investors. It forces us to keep perfect records, think strategically, and use the tax code to our advantage, just like smart investors in other markets have for decades. The cost basis trap is a real danger for the unprepared. But for those who take action, this is an opportunity to get your financial house in order and take control. The time to prepare is not next year. It's not next month. It is right now. The trades you make starting January 1st, 2025 are the first ones that will be reported under this new system. Don't let the IRS decide what you owe based on bad data. Take control of your financial future. Navigating this is complex, which is why we put together a detailed guide on our website breaking down our top crypto tax software options for 2025. These are the tools that will make all of this infinitely easier. You can get that free guide by clicking the link in the description below. And if you want to see a live walkthrough of how to do tax loss harvesting, make sure you watch this next video. Thanks for watching and stay savvy.